Abdulaziz bin Salman, the Saudi energy minister, stated this week that the decision by the kingdom and Russia to extend oil production curbs initially instituted in July was not about jacking up prices, but rather about making the judgments that are right when we have the data. Of course, when that occurred, everyone assumed it had to do with prices. Saudi Arabia requires greater pricing than the current Brent crude price of $70 per barrel. The Crown Prince of the Kingdom has ambitious public spending plans intended to lessen Saudi Arabia's reliance on oil earnings. Everyone assumed that this was the most obvious reason for the reduction, but bin Salman disagrees. It seems that many traders' concerns, which kept oil prices low for the majority of the first half of the year, are shared by the energy minister of OPEC's largest producer. According to the Financial Times, bin Salman stated at the World Petroleum Congress in Calgary, Canada, the jury is still out as to what will happen to Europe in terms of growth. What the central bankers will do in terms of raising interest rates is still up in the air. How the US economy will perform in light of current world events is still up for debate. In other words, Saudi Arabia's energy minister is concerned about the demand side of the oil equation, just as many analysts have been in the past 8 months. The International Energy Agency is the same. It only worries that the supply won't be sufficient to meet what it perceives as an increasing demand. The IEA must be disappointed by the acceleration since it previously predicted that peak oil demand would occur before 2030 and that there would be no need for additional oil and gas exploration after 2021. I believe it when I see it. That's my mantra, and it's always best to live by it. Hallelujah, when reality manifests as predicted, we can generate more, bin Salman added at the business gathering. In fact, it would be challenging to refute the official's assertion that supply and demand estimates are frequently inaccurate. Just think back on all the predictions for this year's enormous Chinese economic growth, which might have led to higher pricing earlier in the year. However, despite the fact that China's oil consumption set record after record, the market remained preoccupied with local economic data, which kept prices in check for months before the Saudis and Russians finally took more active action. It would be difficult to claim that some of the main crude markets, like Europe and the United States, have been struggling to recover from the pandemic, especially since both of them committed to indirect involvement in the Ukraine war last year. Even so, neither bin Salman nor market analysts should be surprised that the blunder has had much of an impact on oil demand. It appears that neither is experiencing a rush into oil substitutes. While EV sales are growing in both the US and Europe, oil demand in both regions has increased rather than decreased. In fact, despite the oil embargo and the sanctions, the European Union has continued to be a significant buyer of Russian hydrocarbons. All of this shows that oil demand is extremely resilient, which is a finding that shouldn't surprise anyone with even a rudimentary understanding of energy markets, and that Saudi Arabia's energy minister shouldn't be overly concerned about this. However, the Saudi strategy can be anticipatory in a situation where there are many warnings that oil and gas are on the decline as a result of the transition. Big producers had better make the most of their resources now before the peak comes if the demand for oil is set to peak shortly. Any legitimate argument against that would be tough to refute. The IEA was criticized by bin Salman for their estimates of the peak oil demand and the spectacular growth of clean energy technologies such as solar panels and electric vehicles. He claimed, as reported by Reuters, that the organization had moved from being a forecaster and assessor of the market to one practicing political advocacy. The credibility of a previous forecaster's predictions declines when they turn advocate. However, a lot of people still rely on these predictions to make choices that can change the patterns in oil consumption. The subsidy competition between Europe and the United States, which is accelerating the switch from oil and gas to alternatives, is the most glaring example. Taxation is also used in this race to discourage the consumption of oil and gas. This competition is based on predictions, notably those from the IEA, that wind and solar are equivalent alternatives to oil and gas for producing power, including as fuel for automobiles. And on the basis of these forecasts, investors decide where to invest their money. It is understandable why the CEO of Aramco retaliated against the IEA, stating that we need to invest in oil and gas, otherwise we will have another crisis in the mid to long term and we will go backward in terms of using more and more coal and other cheap products that are currently available. It also makes sense that Saudi Arabia's energy minister would choose to play it safe in such a political climate, especially if widespread carbon taxation of the populace saps demand for oil most effectively. Despite the fact that American oil companies are now using the fewest drilling rigs in more than a year and a half, Rystad Energy believes that American crude oil output will reach a monthly record of 13 million barrels per day, BPD, in September. Due to the discipline U.S. shale producers have demonstrated over the past 2 years, production growth has slowed, but the Wall Street Journal quotes an oil research group as saying that output is still rising despite the slower pace. The output from November 2019, the only previous month in which U.S. production reached 13 million BPD, will be compared to the anticipated monthly record in September. This will happen just a few months before the pandemic decimated demand, crashed oil prices, and forced production cuts everywhere else. According to Rystad Energy's analysis based on regulatory filings, satellite imagery, and pipeline flows, U.S. crude oil production is expected to rise even more through the end of the year, with October and four-quarter output predicted to average 13 million BPD. While the extended Saudi and Russian supply cutbacks are expected to tighten the global oil market more than initially anticipated, American output is rising and offsetting some of the OPEC Plus cuts, albeit if at a slower rate. According to Rystad Energy's head of shale research, Alexander Ramos-Peon, U.S. shale production is not growing as fast as before. However, that does not indicate that shale must decline. Ramos-Peon and Rystad Energy claim that despite growth being slower than it was before COVID, U.S. shale is still expanding. Shale companies are producing more oil and gas despite the decline in the number of active drilling rigs, and their output has even surpassed some pessimistic predictions from earlier this year. According to the most recent Baker Hughes data, there were 630 total active drilling rigs last week, which is the lowest number since February 4, 2022. Oil rigs decreased by 8 last week to 507, a decrease of 114 over the course of 2023. On the other hand, major corporations including Chevron, Exxon, ConocoPhillips, and Pioneer Natural Resources reported record Q2 Permian output or increased full-year 2023 projections, or both. On the midstream operator's Q2 earnings call in early August, Tony Chovanec, VP Fundamentals and Supply Appraisal, reported that pipeline operator Enterprise Products Partners is receiving positive messages about activity from producers. Pay attention to what the producers have to say in the second quarter. There are no terrible stories. Everyone is quite happy right now, Chovanec told analysts. Companies are attempting to demonstrate that efficiency in operations and capital expenditures is now king in the shale patch by drilling longer wells. This month, the Energy Information Administration, EIA, marginally increased its predictions for U.S. crude oil production this year and next, and now anticipates record-breaking yearly production in both years. According to the August short-term energy outlook, U.S. crude oil output would increase to an average of 12.78 million BPD in 2023 and 13.16 million BPD in 2024 from 12.76 million BPD and 13.09 million BPD, respectively. The United States, Brazil, Canada, and Guyana are expected to lead non-OPEC Plus production increase, which is anticipated to reach 2 million BPD in 2023 and 1.3 million BPD in 2024. According to the International Energy Agency, IEA, in its closely watched oil market report for September, rising crude oil production from nations outside of the OPEC Plus coalition has so far been able to partially offset the OPEC Plus cuts. The loss of OPEC Plus output, led by Saudi Arabia, will cause a severe supply shortfall starting in September, according to the IEA. This shortage will last until the fourth quarter. What are your thoughts on Saudi Arabia and OPEC Plus, and do you think they can overthrow the U.S. economy? Let me know down below. If you want to continue to learn about business investing and financial education, we have got this video waiting on the screen for you to check out. Don't forget to give this video a like and subscribe for more videos like this. Thank you so much for watching, and I'll see you in the next one.